And I think I got halfway, just got halfway through, and I didn't record. So forgive me for those folks who are just jumping in on this, and I'll try to fill you guys in as I before I end. But I forgot to press record because I was just so excited just to jump in there and show folks what's happening, because this is some major stuff that's happening within our markets that I think is good stuff. I forgot to press record, and I just pressed record. So I will probably definitely do another one of these in the near future, especially after the Fed speak next week. I want to see what the longer term charts are showing us next week. So I'll probably do another one sometime next week. So again, I just pressed record, so you guys still would get some of this good information. All right, here's a look at oil, folks, and I really thought crude oil was going to was in a consolidation mode back in December last year, and I thought it was in a squeeze where it was going to squeeze and break out of this triangle to the upside. Boy, was I wrong. Look at this weekly chart. Consolidating since December, consolidating below the 20-period moving average, and I was just, sure that we were going to get a break to the upside. But I failed to really take a bigger look and see that we really got a bearish crossover in the with the 20-period moving average crossing below the 50-period moving average back in October of last year. And since then, price action stayed muted below the 20-period moving average. Even though we saw some type of consolidation here, it was going to fire off to the upside or fire off to the downside out of this consolidation area. And what did it do? It is breaking to the downside with increasing volume, starting to push on the 200-day moving average on this weekly chart. And we broke out of this triangle pattern, giving confirmation of the new direction in price action. So with this breakout of this pattern, breakout of the support level, it confirms that the new direction or the new trend looks like it's going to be lower in oil. So oil stocks probably about to get hammered, which is why I'm going to show you guys some of the trades that I'm in, which is why I picked up and I saw another thing that got my attention is I saw some unusual option activity in XLE, and I seen some major unusual option activity of out of the money stock. I mean, out of the money options that were way out of the money. And I'm like, why are they trading way out of the money? But it didn't expire for like 4, 5, 6, 7 months down the road. Somebody is thinking that the energy sector is about to have a major move to the downside. The last time that happened, folks, I'm gonna show you what happened when that happened last time, when we had a major shift in energy prices to the downside. So this is let me go to a 5-year weekly chart. Let me show you what happened last time that happened. And it's gonna be more confirmation of what our markets are showing us. So the last time that happened, and I want to point this out so everybody will see that nothing is hidden when you really follow the charts. It's telling you what's about to happen. Last time we had a breaking trend and price actually staying below on the oil chart, staying below the 20-period moving average was back here in 2020. So the oil market gave us a fair warning before the overall market did. We broke below the 20-period, the 50-period, and the 200-day moving average in a major way, and we continued that trend lower. And it looks very well much like it's about to happen again. Look how strong this push on this 200-day moving average is, folks. But look at the oscillators and the Williams percentage, how strong they are reversing in the opposite direction. In the full stochastics returning down in the opposite direction. RSI turning down in the opposite direction. We could be on the verge of seeing a major collapse in oil prices again. That is very negative for our markets. The last time that happened in 2020, overall markets followed the same direction. So how close are we to a possible breakdown? Look at this. Draw this out again. this is a weekly chart. We are sitting right on that 200-day moving average, folks. With the oscillators and the full stochastic, like it's just starting to turn lower. RSI not hit is touching oversold territory. We didn't break below it. Look what happened with the moving averages. We have, again, price action staying muted below the 20 per, and now I can get rid of this since it's no longer relevant because this is broken. And now what happens now? The 20 per moving average is going to act as resistance. So more than likely, what we're probably going to start to see is, like the 20 per moving average normally does, price action likes to stay close to it and ride it. So more than likely, we're going to start to see the 20 per moving average cross lower, continue lower, and eventually we may see the 20 per moving average cross below the 200-day and watch the 50-day start to follow. So if we get this break below this 200-day on this weekly chart of crude oil by, sometime within the next week or two, start to look for much lower crude prices. And because if you look below the 200-day moving average, so I'll draw this out again, look below the 200-day moving average. Folks, I don't see any strong levels of support below this level. We could see a little stop right around here, right around 60. But it looks like I don't see any strong level of support, folks, above 50. Because if we break this level, folks, this is where we broke below back in 2020, and that's 65 bucks. So if we see price action break below 65 bucks on oil, let me draw this trend line so you guys will see that. This is where we started in 2020. That's where we broke below in 2020. If we break below this line at, anytime soon, there's a gap below the market right here. In 2020, there's a gap here. And that gap could definitely be get filled. It got filled on the upside, but that gap is going to probably act as an area of resistance. But ultimately, I think it's not much room from the bottom of what happened in 2020 to the top of where we are now. So we break below that 200-day moving average, folks, we could see oil prices accelerate to the downside in a major way, and it could happen quickly. Where oil goes, market's probably going to follow. Most oil is traded in dollars, so ultimately that's going to put more strain on the financial sector. Let me get rid of these. Oops, I'm going to do that. So that's food for thought, folks. Oil is on the process of making a major break to the downside. All right. So I showed you guys how to spot these trends by using the moving average lines, and showed you how to look for these breakout points, breakdown points. And I showed you guys that to understand where the trends are, pay close attention to the VIX and the SPXA 200R. If you can master that, you can navigate yourself through any aspect of this market, whether we got a bullish narrative or a bearish narrative. In a bearish narrative market, me personally, I don't like to trade, or I don't try to chase stocks that are still showing a bullish narrative, because eventually they'll all end up following the overall market. So again, before I show you guys some positions that I pretty much put on, even if you look at, let's switch to a 4-hour chart, because that's a good gauge as to what's happening here and now. Let's go to as you can see on this 4-hour chart, I told you guys that once the 20 per moving average takes over price action, that's what you need to follow. look at, and this is the 4-hour chart. All of these rallies that we're starting to see, that we see within this market. As we crossed below, as the 20 period crossed below this 50 period moving average, it normally acts as a gauge or as a something to follow. Now, even though we saw, it was about last week, we saw a bounce in price back above the 20 period moving average about a week ago. What did the 20 period average not do? It did not do what it ultimately do. That was a nice bull run. It did not curl back up, which led me to believe that it's going to run into resistance somewhere else. And where did it run into resistance at? Right at that 50-day moving average. So until you see this yellow line, which is 20 per moving average, curl back up, any rally is going to be met with fierce resistance, which is why we see a curl back down right now. You see this big red candle on this 4-hour chart, because price action came down here. Everybody got excited because the market, I guess the federal government and Jamie Dimon, whoever else was pumping liquidity into these banks, trying to help them out, thinking that was going to fix things. Folks, it ain't fixed nothing yet. Market is still on jitters. Price action back up to this 20 per moving average, and look what's happening. I told you this 20 per moving average is going to act as resistance. Anytime there's a lot of space after we seeing a drop or a rise in between price action and moving average, folks, moving average, price action does not like to be too far away from the moving averages. They act as a magnet. So we got this big drop below 20 per moving average, but 20 per moving average continued to go lower. So more than likely what was going to happen, we was going to get a nice rally over the past, day or two, but run into resistance at the 20 period. And if for some reason price cannot break above the 20 period, what happens then it is confirmed that the 20 per moving average is acting as resistance. So what happens now? We should see the 20 per moving average continue to go lower, and price action continue to try to get bullish, and 20 per moving average continue to push it lower. Look at the oscillators and the wins percentage after this little rally over the past day or so. The oscillators win percentage hit the overbought territory and it's coming right back down. And I told somebody the other day, I said, be careful trading this little bounce we saw about a day or so ago, because it's probably gonna get rejected. Because the bears, and you guys just joined me, I showed you guys how on the longer term charts it's showing us that the bears already took a hold of this market. So that means any noise you see, in this, within this bear market, any noise you see, when you see a huge drop and then obviously you see a big rally, if these moving averages have not changed their positions, those rallies are going to be met with fierce selling. We had a gap down here between Monday, I want to say Monday and Tuesday, and that led to some temporary oversold conditions. And what happens? We get a nice rally. And folks who did not understand how to read charts and look for support resistance levels at these moving averages probably thought, oh my goodness, okay, everything is turned around, the banks are being fed, we're ready to break out. No, 20 period moving average did not change its position. It stayed above price action. So what happens after this little rally, runs up to this level, gets stopped out, and there we go, back down. Also, more confirmation, we're starting to see the 50-day now cross below the 200-day. That is extreme bearish. We had the 20-day cross below the 50-day here, then the 20-day cross below the 200-day here. Now we have the 50-day that's crossed below the 200 days. Now we have the 20 period moving average and a 50-day below the 200-day, all bearish signals. There's nothing bullish about this market at all, folks. Nothing at all. And I don't see any a bullish narrative in sight at all whatsoever. So if you got a long-term bullish narrative, you might want to rethink that and just try to trade these bounces. If you want to trade them bounces. Me specifically, I have not been in a bullish trade, depending on what side of the what sector is in a long time. I've been trading a bearish portfolio for quite a bit now. Now, with that said, so when I showed you guys, what's going on with this overall market, let me show you guys some of the positions I'm in, but let me show you guys some levels again, some key levels. Go back to a daily chart of each one of these, some key levels that we need to really pay attention to now. And I'm gonna switch to my cleaner chart to look at this. And we're gonna look at a weekly chart. All right. Let's switch screens. All right. Now, again, you could definitely see some rallies within the context of this market, but there's some key levels that we need to pay close attention to, which could really break this market in a major way. All right, here is the Dow Jones. Let me show you key level to pay, some key levels to pay close attention to. I may have to switch this to a monthly chart because I need all of my information to be in sight. All right, here's a monthly chart. Key levels to pay close attention to. All right. One of the first ones, looking at this Dow Jones, we're already starting to break up below one key level of support. It's right around here. So that is no longer in play. Next one I'm really paying attention to, so not even paying attention to this level here, which is around 30,000. Well, 30,500 is going to be a key level too. That's going to be anything below 30,000. Highlight that. So 30,000, right around 30,500. That is a key level to pay close attention to. Any around 30,500. So pay close attention to that. But the ultimate is the October bounce. The October lows, folks. That's what I'm really focusing on next. Okay, 30,000 is going to be, you know, because it's just a round number in the Dow Jones. 30,000 is going to be our first target, but the second target, Dow Jones doesn't hold that 30,000. We can revisit the October lows. And that's something to really keep in mind, is that we can definitely start to revisit the October lows. If for some reason price action does reach those October lows, folks, and doesn't get a strong bounce, look where the October lows were, where that bounce was. So the reason why we got that strong bounce in October, that was because we reached the point that we broke down from in 2020. So we reached the high in 2020 in October, and markets, you know, got a strong bounce from that level. But that was a strong level of support. Former resistance becomes support. So this was resistance back here. On the way back down is going to come support. Got a strong bounce from that support level. And it looks like we may be heading down to test that support level again. If we do not hold that support level, if we do not hold this level, and this is around 28,000, around 28,840. If we break below that level, folks, we're really going to see the bears. You think they got their teeth dug into this market now? We ain't seen nothing yet. If we break below the October lows, which is around 28,700, things gonna get real ugly. So wanted to point that out. That's something to pay close attention to. 30,000, and then if we break that level, 28,840 is going to be the next level to watch. And that's the Dow Jones. Now let's look at the S&P 500. And you can already see that this is a monthly chart we're looking at. You can already see the oscillators and the wins percentage full stochastics and the CCI, they're starting to turn lower again. Hit oversold territory. Didn't stay, popped out oversold territory, and it's ready to turn low again before we even get, you know, in the overbought territory. So that's telling us that the bears are really taking the teeth on this market and keeping price muted. So the ultimate level here is, again, October lows, and then if we break below the October lows, right here, folks. Let me get rid of the October lows. Rid of that. Right here, the breakout, the breakdown, the highs of 2020. It's going to be oh, it's wrong. Highs of 2020. It's going to be in focus if, for some reason, we break this trend line right now. If we break below 35,000 in SPX, we're looking at this level here, which is around 34,000. Break below 34,000, all bets are off. We're going to see major action to the downside. That is the S&P 500. As far as the NASDAQ is concerned, it's been trying to show some resiliency here, but I think it's about to turn lower already. It came out of overbought territory, but I think it's going to turn lower very, very quick because even though the NASDAQ tried to show some strength, it's been unable to break above this level of resistance here, around 12,000. But I'm unable to get really above 12,000 in a major way. Oscillators are coming out of oversold territory, but I think it's about to turn back down quickly. All right. So, all right, to pay close attention to in the Dow, in the NASDAQ, 11,225, 11,225. We get below that. The next level to pay close attention to is 10,316. Then after that, I would say that the next level is going to be the the 2020 lows to pay close attention to. And as far as the Russell 2000, it is the more dire of the bunch already. It's already starting to show some major breakdown. And the Russell is the closest to the breakdown of 2020. Right now, the target for the Russell, I'm going to clear this up even a little bit more. So I'm going to try to pinpoint this. So what I'm doing now is I'm going to draw a horizontal line from the wick where we started. It's the wick here, where we started in 2020. And let you guys know. The Russell was right there, folks. Right there, 17,000, 1,000. Yeah, 1,725. 1,725. We break below that level, folks, on the Russell. All bets are off. Then we can start to see the Russell really start to take off and be in the same area that we were in 2020. So 17,000, we're almost there. 17,025. See the Russell break below that level. Normally, the other indices follow. They follow each other eventually. So the Russell is very, very close to a major breakdown, folks. Extremely close. With strong red candles on a monthly chart already. Look at that. And you got the oscillators and the stochastics is ready to turn lower again already. Williams percentage ready to turn lower. CCI, which is another tool I use on one of my other screens, ready to turn lower and cross with a sell signal. And let's see, let's switch back to weekly chart. So you already have the Russell that's just pushing on this level of resistance. I'm sorry, level support. So folks, there is no bullish narrative in this market whatsoever. No matter what you see, it's not a bullish narrative in sight as of right now. And with that said, here is now some of the positions that I saw a lot of unusual option activity over the past couple of weeks or so. One of them, first of all, was gold. Gold and silver has been showing a lot of activity. It's showing a lot of activity. I do mean a lot of activity. And within gold and silver, one specifically, the GDX, which is a gold miner, stood out in a big way. And it was showing some major paper, folks. And look at the weekly chart on GDX. Just starting his bullish narrative. Look at this nice gap up this week. That is beautiful. So after it had this cup and handle pattern, boom, boom, it's ready for the breakout. Look at the oscillators, stochastics already starting to turn higher. Williams percentage, CCI already starting to turn higher, which is why I believe there was so much unusual option activity showing us several days ago. I got into it a little early, And the paper that I was seeing, and I mean, folks are really making some crazy bets on this. Going all the way out to September, folks were buying a lot of the, let me show you, let me see. They were buying a lot of the longer term strikes that were out of the money around the $34 to $40 level. Even 50 strike calls they were buying. Let me see if there's still any more strong paper that's popping up in this today. Yep, and they still all the way out to September. Look at this, 8,000 contracts. You guys never used this tool before. I like using it. Option time of sales, and it shows you where a lot of the activity is happening. If it's blue like this, it's showing a lot of call activity, and purple is showing a lot of put activity. But there's some big paper being traded around the 50 and the 40 strike calls in September, and this is showing what's been traded today. I started seeing the same activity and the same strikes, folks, over a week or two ago. So they've been accumulating. It looks like they've been accumulating, speculating that something's going on in our overall markets, you know, when our overall markets that they wanted to be, that they wanted to feel, they wanted to feel safe. So between the 40 and the 50 strike calls, they've been really buying these up. But when I saw it last week, folks, I'm telling you, one day I looked at it, it was 80,000 contracts traded around the 40 and the 50 level. 80,000, only say 8,000, 80,000 contracts were traded around the 40 and 50 level calls. It lead me to believe that somebody was putting on a spread, possibly buying the 40s and selling the 50s, and it was extremely cheap. So if somebody is speculating that we can see a major run in gold in these gold miners over the next several months or so, and that's what I believe is happening. And the chart's showing me, charts is also giving confirmation that there's possibly a major breakout that's brewing within the gold sector, which leads me to believe that with these contracts saw there possibly some type of spread that somebody's been putting on. And again, when I first saw it, it was 80,000 contracts that were traded, and they're still buying these contracts or still trading these contracts, whether they trade them for a position for now, or they accumulating to hold on to positions. So position that I actually got into when I first saw it was I bought the 34 strike calls, sold the 38s, went right back in probably a few days later, bought the 42 strike calls on the GDX and sold the 50s, creating that spread. And when I say it was extremely cheap, I think for the 34s, selling the 38s, I think I paid about $75 a contract for those. And for the these are all September contracts. I didn't buy the 40s when I first saw this. I ended up buying the 42s, and I paid $28 a contract. Now, what it looks like now, and for those who don't understand or don't trade spreads, let me just show you one thing I like about TOS is it shows you what the possibility of a profit is if these out of the money contracts become profitable between now and that time of expiration. So if you was to even as it stands now, somebody was to jump in and they was to try to put on a spread. Right now it's only $60 for a 40-50 spread on the GDX. And when you go here, it tells you what the potential profit could be. So if you were to spend $60 and nothing, and let me put it to you like this, nothing right now, nothing right now shocks me in this market. We've seen big moves in some of the stocks within the banking sector. We're seeing some of these stocks drop 20, 30, 40%, 50, 60, 70% in several days. So would it shock me to see a major move to the upside in gold when some of these out of the money stocks can become out of the money positions can become very profitable? No, it would not shock me. So is it possible? It is possible. We already saw what was possible with those financial stocks. If you had some of those out of the money contracts, you made pretty good penny. So here with this one, the max amount that you would put out for this particular contract is $60, as you can see here. And the maximum profit is $940. So $60 to make it $940 between now and September. I think that's worth the risk. That's why I say I'm a trend trader, because I normally would not buy an out of the money position like that, so far out of the money, unless I see a trend that's just changing and we have time to make it up to that level. Even before, with so much time to expiration, as the as price action starts to move, you'll see that particular option become profitable if you get in at the right time, well before expiration. It doesn't even have to reach that first strike before you start to see profit. My positions that I'm in now, they're out of money positions, but they're already profitable. I can run away with profit right now if I wanted to. But I believe that we definitely going to hit the longer term strikes. And I think my longer strikes, which is why I want to stay in this for quite some time, because I think we're going to end up hitting those levels. So I'm confident to stay in this because I see the trend change. Same thing with the some positions that I traded to the downside. Let me show you some of those. Oh, let me show you also. The SLV was another one that showed a lot of unusual option activity lately. Just starting to fire off. Just got into these contracts probably. And this one was a very long-term contract. Folks were buying, and this one you could probably do something shorter, but I'm not like to trade where I see the action is. They were going all the way out to December. The last I think the last week in December, they were buying the 21 strike calls of the SLV that expires the last day or last week in September. I mean, I'm sorry, in December. And same thing with this. This paper was started trading a couple weeks ago. So there was a lot of folks taking big bets, and now we have, look at this, bets for June, bets for September. But when I first saw it, it was a lot of folks that was going all the way out to December, all the way out to December, and they were buying up the 21s. They were buying all the way out to the 27s. They were just buying them all about over a week or so ago. So I jumped in with a spread on that one too, and I ended up buying 21 strike calls, and I sold the 27 strike calls. And at the time, I paid about $1.30. And right now, I'm currently up on that particular those contracts by about 7%. On my GDX contracts, already up on those about 30%. And about, let me see, yep, about 30 to 35% each on the GDX contracts. And I haven't even reached the first strike yet. So that shows what happens when you can jump into a new trend at the right time. Now, also, with so much negativity in the market, I also took some bearish trades when I saw that the bull trap the bull trap that started back in October, when I saw that start to fizzle out, and definitely proved to be a bull trap, I jumped into some bearish trades. And the way I found those, they were also some positions that I saw that were showing some unusual option activity to the downside. One was the XLE. The XLE shows some major, and I mean major paper, and I like this setup on this on the weekly chart. Looking at this weekly chart of the XLE, it's showing a major shift, folks. Which and after I showed you guys what was happening in oil, I kind of understood why folks were buying these way out of the money. I mean, way out of the money, because there's it's showing a sharp turn already. Look at the CCI and the oscillators and the full stochastic percentage. They're showing some major moves to the downside. And look at the volume. A lot of folks are jumping into a negative narrative on the XLE. And if I was to draw some ranges in here, oh, sorry. It's not far-fetched to see the XLE break these levels. So from here to here, It's a diagonal level of support. So it's not far-fetched to see the XLE come down and break below this $70 level. I think this upper level of support, upper level of resistance is far gone. Don't think we're going to see that anytime soon. So I think the upper level of resistance is far gone. I think we're about to test this level of support. And ultimately, the XLE breaks that level. There's nothing below keeping it from going much lower. Nothing whatsoever from keeping it from going much lower. Now, again, this is what happened back in 2020. And right now, I'm really starting to eye everything that happened around in 2020, folks, because I think we had to test this level, these areas of 2020. So that drop in 2020, we started to descend in the XLE right around there. So that's right around $60. If we break below the $70, it's not going to take us any time to hit 60. And what folks were buying, I kind of believe is a possibility that we can get there. So we break below this level, we can really see a huge sell-off in XLE to the downside in a major way. And what they were buying, folks, you'll be shocked. And it was major paper. I mean, one day I saw it was probably about 100,000 contracts traded on the put side with two particular with a spread. They were getting into the XLE by getting the, let me see, what was it? 50 to expire in September. I'm sorry, expire in June and July. Folks were placing a bet that they could see the XLE drop below 55 and $58. So they were buying the 58 strike contracts, they were buying the 55 strike contracts, thinking that we're going to see a major downward shift. If that was to happen, those contracts, out of the money contracts would be very, very lucrative by expiration. So if we did drop to those levels, and this was it's about a couple of days ago, they were buying the June expiration 50 strike contracts. They were trading, I mean, they were dirt cheap. So it was only about $20 back then. And they were buying the July expiration contracts, which were also dirt cheap at the time, around 50 and 55. That's what they were getting into several days ago. So if the XLE is about to, it's about to continue its trend lower, those contracts are very inexpensive. So it's only, you only risk $25 to make a huge bet on a potential continuation of downward pressure on the XLE. Also, another one that showed a lot of activity was the XLI. The XLI was also showing a lot of paper, a lot of put option activity, and we're starting to see some increase in volume in that as well as price continue to drop. And this paper was showing several, probably about a week or so ago. On the XLI, they were getting into the May put option contracts. And they were trading around the 95 strike puts. And this was several days ago. But they were like they was putting on a spread between 95 and the 85 strike puts. So of course, it's a little more now, but still, if you look at the price action, it looks like we are definitely headed towards 95. And if we break below this level, there's strong support at 85. So I see why they were actually putting a spread on for 95, buying the 95, selling 85. Support is strong right at the 85 level. of the XLE. So if we drop below there, drop it to that level, you can get maximum profit for a spread by purchasing the 95 puts and selling the 85 puts. So there was a lot of paper showing there on the put side for the XLE. Another one that I got into a while ago that shows some major paper was the KKR. Shows some major paper. This one I'm probably very, very close to, well, not too close, but getting close to max profit. This was one that showed some major paper probably about a week or two ago, about 2 weeks ago. When I got into this, it was trading around 55 bucks. Right now we're at about 48 bucks. They were buying the June put spreads, buying a 50 strike put, selling the 40s. So when I got in this, we were well above, it was around 55 bucks. We're right now just below 50. And my particular spread right now is up about 200%. And I still have several months left to go. So, and the direction, again, I like to trade trends. Normally where I trade, I don't trade for looking for percentages. I trade look to see where the trend may be ending. And right now, it looks like the ultimate level, looks like we can see the KKR come all the way back down here to about 42 bucks. That's a level of support, which is the level of support that I like to target. There's also a level of support right around 45, which is right here. Then there's a one level support a little lower than that, right around 40, 42. So between 42 to 45 is the level of support that I am going to target. And that's when I'll be ready to possibly close that position. And if you look at the options market now, haven't looked at it in a while. Still some paper in here, but it's not as much as it was trading several days ago. But the narrative is still negative for this particular stock, because if you look at the charts, it's showing us that a new trend is formed, a downward trend is formed. And if I switch over to a screen where I have my moving averages, you can see where the breakdown is probably about to happen. So on the KKR, we already dropped below the 50-period moving average. Now it's ready to challenge this 200-day, which leads me to believe that it shouldn't be hard to break that, knowing the overall narrative and the sentiment of the current status of our market. So if we start to break, here's a monthly chart on the KKR. I think it's going to be nothing for the KKR to break below this 50-period moving average, which could send this stock plunging, just like a lot of other stocks. And we could hit $40 in no time. So that gave me confidence on this. And then you see, again, look what's happening with that 20-period moving average. It's starting to act as a level of resistance, which is going to start to curl lower and push price lower. So we could be at $40 in no time. So that gave me confidence to hold on to that trade. Even though it's up over 200%, I think there's a lot more to go. If we, sorry. If we look at the XLI again real quick, I'm looking at this monthly chart. I'm sorry, this monthly chart. It's just starting to break below its 20-period moving average, which means that this downward trend is probably just starting. I can get rid of this. This is no longer relevant. It's like we are well below this level of resistance and we're starting to break lower. So like this downward trend is just beginning. One more was the BBWI. There was some major paper in this one, and it's also just starting to shift lower. And it looks like the rest of them. Look at that 20-period moving average, folks. It's like a sphere. It's starting to curve lower, which means it's going to keep price muted, which means there's more pressure to the downside than there is confirmation for a breakout to the upside, which gives me more and more confidence to stay in this trade. That's the BBWI, which is Bed Bath & Body Works. This one was a shorter-term trade. God dang it, I done broke my phone. Sorry about that, folks. Dropped my phone again and like the screen cracked. Hopefully that's not the case. Maybe it's just my screensaver. I mean, my screen save. All right. Anyways, so this position I got into with the BBWI, it shows some unusual option activity. This is, again, I saw this probably about a couple weeks ago. This one, it was a lot of paper trading with the put spread, where folks were possibly buying it, the 37.5 strike puts, selling the 32.5 strike puts. Again, when I started seeing a shift in the overall sentiment of the market, I jumped into this particular put spread, and now it's up over 100%, which still with more room to the downside showing. So that gives me more confidence to hold on to this one even a little bit longer and look for maximum profit. Look at what's happening. We're already starting to dip into oversold territory on the RSI. This one I'll probably be closing out very, very soon, because I do think we could push towards 30 and by the end of next week. So this one will probably be something I'll take profit on. But look at the crossover. We have the 50-period moving average is now crossing below the 200-day. That's a strong bearish signal. So we could see this one continue to drift lower. And as of right now, folks, this market is really it's under a lot of pressure. You're starting to see some pressure on even some of the big boys that really starting to show some signs that it's starting to fizzle out. Apple looks like it was trying to break out, but it's like it's starting to fizzle out too. Apple might be at the end here. Here is Apple. Here's Apple right here, where it's trading right around a level of resistance. And it's like it's pretty much stalled out there. So could we see Apple pretty soon break back lower? That's a huge possibility. That's a huge possibility, folks. And let me see if there's anything else I want to show you guys as far as that's pretty much it. So again, I think the bears are definitely in full control of this market as we take another look at the SPXA. I'm sorry, the S&P 500. Here is again another look at the S&P 500 before I close this out. Let me get rid of this. Here's another look at the weekly chart on the S&P 500. Next week again, folks, don't forget there's Fed speak next week, where they will announce our interest rate move for next week. Here's where we sit at now. Again, this range that we're in now is going to be very detrimental to the markets. If for some reason that we break below this level, so we see this S&P break below this 37,000 level, we're going to start to see an acceleration to the downside. Here is a monthly daily chart at S&P. Look what happened. You know, the bulls tried to jump in here this week and was muted right around here. Bulls muted right around here. And right back up to this level. They tried to go up, and then all of a sudden it got pushed lower again. And if I was to pull up a 20-period moving average here. 20-period moving average and the 50-day. Look what's happening. Again, for those who joined me late, I told you pay close attention to the 50-day and the 20-period moving average, because it's going to act as a level of resistance as we speak now. This blue line is my 50-day. The yellow line is my 20-day. Look where price action is coming to a head at, right at both of them on this daily chart. The bulls don't push above it. You know, we're going to see the moving average start to curl lower, and they're going to act as a level of resistance. And you'll see price do this kind of action. I think that's what we're in store for. Look at the oscillators and the full stochastics. They're all trending lower. RSI all trending lower. That is not positive, folks. That is negative, even with either this green candle that we see on this weekly chart. Let me switch this to as a matter of fact, I'm going to switch it to a daily chart. I'm going to show you guys how strong this downward trend is. Price action tried its best to get a nice little rally this week, but look what's happening. The 20 period moving average is now on its daily chart. It's crossing below this 50-day period moving average. Excuse my dog. And it's got stopped. It's got stopped out right at this 20 period moving average, which is acting as a strong level of resistance. So we're going to start to see, even on the shorter term charts, shorter time frames, we want to see this 20 period act as a level of resistance, which is what's happening here in this daily chart. And even if we was to look at a 4-hour chart, folks, for those swing and day traders, you can see well-defined levels of resistance. Here's a 4-hour chart, folks. Well-defined level of resistance. We saw price. You saw price trading lower, dip below the 20 period moving average. And I told you guys, price action doesn't like to be too far away from the moving averages. Dip below the 20 period moving average and the 200-day, but there's a lot of space in between here. So what happens? We get a nice little rally over the past couple of days or so, where to back up to that strong level of resistance. Price action got met by the 20 period moving average and the 50 period moving average. Look what's happening. Told you guys, unless, what time frame we're looking at, unless we see this 20 period moving average shift and start to curl back upward, it's a bearish narrative. And we did not see that even on the 4-hour chart. Price action rallied up. 20 period moving average did not turn up with price. It continued lower. And what happens? We start to turn lower again. We started to turn lower again, folks. So even on the shorter term time frames, you see that this bearish narrative is extremely strong. Here is the Dow Jones, same thing. Price action attempted to start a bullish trend over the past day or so. This 20 period moving average, what is it doing? It is keeping price muted, keeping price submerged below this 20 period moving average. Now 20 period moving average starting to curl lower. Price action is running into that area and is continuing to go lower, even on a 4-hour chart. And that's happening pretty much almost across the board. With the exception of, this is why I say we could start to see a major pullback in the NASDAQ, because it's the only one on a 4-hour chart that's still managing to hover, and I say hover because that's all it's doing, hover above its 50 period moving average and hover above the 20 period. We can see this fizzle out by next week, by the end of next week. We can see, we starting to get these red candles starting to form on this 4-hour chart. If the NASDAQ can't hold that level, can't hold the line, we'll start to see this one doesn't do the same that the other indices are doing. We'll start to see price action drop below, 20 period moving average cross above. Start to trend lower. We already got the signal back here that the overall trend is possibly ready to change with this 20 period moving average crossing below the 50 period moving average. Price action just hasn't started to bend yet, along with the moving averages, which I think is about to happen. That's the 4-hour chart on our NASDAQ, and then the Russell. And it's already at a dire state. So Russell looks the worst of the bunch. It is just muted below the 20 period moving average, the 50 period moving average, and the 200-day. Not going anywhere. And one more look at the VIX on our 4-hour chart. Look how strong the VIX is. It's maintaining its overall move above the 20 period moving average and using it as a level of support. So every time the VIX pulls back, it's getting a bounce. It's getting a bounce. So now we'll start to see the moving average start to continue to curl up as the VIX use it as a level of support. Ultimately, I think once the VIX finishes this consolidation above this 20 period moving average, folks, I think the VIX is going to have a major breakout. And this is the ultimate. This is the first level of resistance right here. Let me highlight that. Right around 30. You see the VIX eventually break above this level, it's gonna take off running. So that 30 level over the next week or so is something to pay closer attention to with the VIX. And look at that. Another confirmation that the VIX is not ready to have a major pullback. Look at the oscillators. I mean the moving averages. The 20 per moving average is just constantly moving up. As prices is doing this thing up and down, up and down. The 20 per moving average is not turning lower. It's just continuing to go up. That is a bullish narrative. We almost, but not quite, got the crossover with the 50 per crossing above the 200-day. Hasn't done it yet, but it's like it's setting up to happen. Once that happens, we'll see the VIX probably have another strong move to the upside. That's the 4-hour chart on our VIX. And let's take a look at the 4-hour chart on gold for the heck of it. Are we here? And that is just strictly bullish. Look at that. In overbought territory right now, so we could see a little pullback, but overall narrative is that it's strictly bullish. So any pullback is probably going to be met by what? The 20 per moving average. Because now we're starting to see that space in between the moving average and price, which price doesn't like to be too far from the moving average. So we're going to probably see these two come together at some point. We'll probably see a pullback towards the 20 per and then continue to take off. The silver on this 4-hour chart, same thing. Silver is just starting to take off. So we could see a lot more upside in silver before we get a pullback to the moving average. But again, 20 per moving average is starting to rise along with price. That is a good bullish sign. And one last thing, look at crude. Crude does not look healthy at all. It looks strictly bearish. Definitely muted below the 20 per moving average. Right at a level of support. So it stopped right around 65. Told you guys, if we look at that 65, we drop below the 65 level, you can see crude race to 55 and even 50 in no time. So, all right. So again, hopefully this is something you guys can use. And again, for those folks who have joined me late, hopefully I was able to get back and review some of what I went over. And for those who joined the record, I'm gonna get this on a recording. Hopefully he was able to catch something here. Again, folks, pretty much again, my trading style is I'm not a day trader. I don't trade futures. I keep everything simple. I like to look for trends. So if I spot a trend on the weekly or the monthly chart, especially if I see a pivot point at a high point or a low point, and I can confirm that a trend is forming, I like to get into that trend when I first see it start to form. Good way to measure support resistance is definitely use your moving averages. I like to use the 20 per moving average, the 50 per moving average, and the 200-day moving average. They will definitely give you a strong sense of what's happening within our market. And also pay attention to the VIX, because the VIX will also give you a gauge of what's happening in our overall market. One thing I wanted to point out to, that I probably didn't do before, but I'll do it now. I'm not sure if I did it or not, but you could have if you was monitoring the VIX throughout this year, you could almost get a sense of when overall sentiment was probably about to change. Because if you look back at the VIX way back here in November, see how the VIX was just muted below these major moving averages, which is showing that the VIX was really not going anywhere, but it wasn't really breaking down either, because this highlighted area you see me have down here, it was in between the $17 to $20 level. The VIX was pretty much coming down to a consolidation area, folks. It was just waiting for a move to fake out the bulls in this bearish market. The VIX was staying muted below 50-day for quite a bit. Then all of a sudden, we saw the 20 per moving average start to shift and trade back above the 50-day, and we saw price action start to move up with it. That was a signal right there to let folks know that this overall bull rally we saw started back in October. That was a signal right here that it was coming to an end. It was coming to an end. So that was your chance to, okay, let me go ahead and start to switch partners and find some other positions to get into, to ride the new trend. This was a new trend that was forming, a new trend showing that the VIX was starting to ride. VIX was starting to pop, starting to jump out of this level. It was starting to jump below, above the $20 level. And looks, the VIX is firmly above the $20 level and doesn't appear to be going back anytime soon. So that's pretty much telling me that the October rally in our markets is probably more than likely came to an end for now. And also, if you look at the SPXA 200R also, that's another gauge to determine overall market sentiment. Again, the SPXA 200R is a tool that tracks overall market sentiment. And right now, looking at this tool, we see that it is starting a strong downtrend. It had to move above the 200-day moving average, so that was muted. And look at this, all these red candles in a row. It's definitely strong. And for this tool, folks, again, I told folks earlier that here is where we at now. This tool tracks the percentage of S&P 500 companies that are trading above their 200-day moving average. The highest you can get is 100%, because that means you will have 100% of stocks above their 200-day moving average. The lowest you can get is 0%, which means you're going to have no stocks trading above that 200-day moving average. That 50 level is a key level that I always pay attention to. Because on the way down, you drop below 50, that means overall sentiment of this market is negative, and we're going to probably see a continuation of the sentiment continue to be negative, especially when you see the moving average, the 20 per moving average, and it start to overtake the candles in here and starting to stay below the 20 per moving average. Right now, this percentage is at 0.36, or should I say 0.37, because it's at 0.369, which means it's only 0.36 stocks trading above their 200-day moving average, meaning that there's more than 70%, more than 70, or just about 70%, or close to 70%. That's a 65. 65% of the stocks trading below that 200-day moving average, which is a bearish narrative for the overall markets. So again, if you pay close attention to this tool and the VIX, it'll be easy for you to spot the trend that's about to form. All right, folks, it's about almost 2 o'clock. I think I talked enough to show you guys my stance as far as trying to navigate through this market. Again, I like to look for these longer term trends because I can open up a position, open up a trade that's going along with the overall market, overall sector that I'm looking at. And I can hold on to that position for weeks and months, for weeks and months to come, and feel confident because I know where support and resistance levels are. All right, for those folks who are with me now, if anybody have any questions, now's your time to shoot them off before I head out. You can type them in the screen, or if you can type them in the message bar here, or if you want, you can unmute yourself and fire away before I head out. Hopefully this was helpful, folks. And if it was helpful, you guys found it useful, I'll try to step in here from time to time, especially if I see overall sentiment of the market trying to shift or change. All right, folks. Going once, going twice. Okay, we got somebody. Yeah, it was a bigger. I don't find it trickier. One of the reasons why I say I don't find it trickier because I don't mind waiting. I'm very patient. The reason I say I don't mind waiting is because I'm not somebody who's sitting in front of a screen every day. I got a lot of things going on. I mean, I don't have time to sit in front of a screen every day and see what's going on. So I analyze the daily, monthly, weekly, and monthly charts, you know, throughout the week. And once you can point out, and let me I like to pay close attention. And let me clear up some of these screens. I like to pay close attention to longer term support resistance, because those are going to be stronger levels where you can see price action change in a shorter time frames at a dime. You could be watching a shorter time frame and think that, things about to go to the hill, but if you don't know what's going on with the longer time frames, they are more stronger. Signals are more stronger there than they are in a shorter time frame. You could be trading a trend going off of a daily, a 4-hour chart or 1-hour chart. It runs into a level of resistance. You think it's just a short-term pullback, and then it intensifies and continues for days out. A lot of times that can happen because it ran into a major level of resistance on a monthly chart or weekly chart that you don't know of. If you don't make that known to yourself, you can find yourself trying to continue to get back in every time those 1-hour charts or 4-hour charts turn positive, and then they just keep hitting resistance. So, example, here is my here is a longer term chart, a weekly chart of, let me switch to the S&P 500. Let's do that. All right. So, looking at the S&P 500, you can almost see, and I can even bump this down to a weekly chart. All right. Let me switch to, all right. One of the things that I like to definitely keep in mind is I want to see if there's future, if there's a past that you can glance at, that also is a great help. But even if you can't see what's about to happen in overall markets, if you look at this tool that I like to share with you guys on a regular basis, because it shows you the overall sentiment of the market, you can almost see a change of direction before you see it in the actual movement of the indices. You can see consolidation. You can see what the moving averages is showing you. But ultimately, this tool right here, this is what led me to believe that we were ready for a major change. This SPXA 200R, the highest you can get is at 100%. We were at 97% back in 2021. This is on a monthly chart. When we got up to around 97%, I started to really pay close attention, to start to look for some shifts in sentiment within this particular tool, by paying attention to the candlesticks themselves, by paying attention to the oscillators and the wins percentage, paying attention to the TTM squeeze, paying attention to the full stochastics and RSI. If you kept an eye on this by itself, you would have started to see a shift in the market well before you saw it in the actual indices themselves. Right here, there's a long wick right there. It's on the monthly chart. We see that long wick. Normally, there's some type of indecision or something that's about to change. Look down in the full stochastics, and you look at the RSI, which is starting to create these lower highs, and you start to see a bearish narrative after being in overbought territory for quite a bit on its monthly chart, and they all line up with each other. That's a sign right there to me that something is about to shift. There's a change that's about to happen. So that gives me a head start to start looking at a change within the overall markets. Even if I was once I confirm it there, I would just bump it out to a weekly chart and see what's happening here. So on this weekly chart, when I look at that 97 97 level. It's up here. Then what I'm starting to see by looking at the shorter term time frame, which I switched from a monthly to a weekly, I see how the candles are now starting to cross below this 20-period moving average. And then right around about a month later, you see it's staying below that 20-period moving average. That's confirmation that this trend is changing to go lower. And once we shift below that 20-period moving average, I know for a fact that a trend has changed. Look at the Williams percentage was in deeply overbought territory right before we started to right as soon as we saw this 97%. And what happens? We get a deep dive of the oscillators in the Williams percentage. And then if I was to switch to the actual S&P itself, looking at that same time frame, weekly chart, the S&P itself, if you look at the RSI, it gave you a fair a warning ahead of time. Look how we was in overbought territory in S&I from, the RSI from March of 2021 all the way up to August of 2021. Then the RSI started to show some problems. Price action remained above its 20-period moving average, but the RSI was giving you some warning that something is probably about to shift. We went back into overbought territory again. And from that time frame, when we went back to overbought territory again, look at price action between October of 2021 to the beginning of 2022. Pretty much stayed in a range. Stayed in a range. Okay. And within that time frame, while we was in that range, price action was still above the 20-period moving average until that shifted. And once that shifted, you also saw a shift again in the RSI. But RSI really dropped out of the overbought territory and started to trend lower. Price action finally dropped below its 20-period moving average. That was confirmation to me, gave me enough confirmation to believe that we were definitely heading lower because all your oscillators showing the same thing. And you saw all of this before the rest of this occurred. See what I'm saying? You saw all that before the rest of that occurred. So we can really understand how to follow these charts. And then once you saw that on the weekly chart, okay, like to use a shorter term chart. So you got confirmations there. Look at them at the daily chart. And I'm gonna draw this all the way back to as well, as far as I can go. So same time frame, right around the beginning or towards the end of 2021. So the ultimate, we already saw what the weekly and the monthly was showing us that when we got around this time frame, we started this sheer shift. So that told me that, okay, we're probably about ready to see a shift. Once we got this crossover on a daily chart, we have the 20-period crossing below this 50-period moving average and staying muted. And once we got the price action also crossing below this blue line, which is my 50-period moving average, is staying muted. The moving average is starting to tell you what's happening. These are all bearish signals. Price action jumped above this 20-period moving average and the 50-period moving average here, but the 50-period did not change. It stayed in its overall trajectory lower. And then what happened? Price action fell below the 50-period, the 200-day, stayed muted. All of this move, okay, if you were a longer term trader, okay, you would have been able to, to stay in this, longer term trade. Now, what would have made some folks nervous, and I can tell you how to get over this nervousness, is when you got around here, when price action found a level of support. So you want to, when you start to see a shift in sentiment, you want to also draw out to look at the longer term levels of resistance, of support levels, because once price action becomes so far away from the 200-day moving average, you're going to see this end up, starting to have another a short-term bullish narrative to the upside, which could pretty much scare you out of your position, your negative position, if you don't understand, that how much time you need to give yourself. Okay, so what you can do in order to defeat that is by paying attention to how far away you are from the moving averages. We were real close to the 50 per moving average here, real close here, got down to a level of support, a strong level of support. So let's see what that was. That's another thing too. You want to be able to find these strong levels of support. And where you're going to find those at? Only by looking at the long-term charts. That was around 37.50 on the SPXA. Let me draw this out to monthly. All right. Here's our monthly chart. When price action was started to head downward, one area that you were able to determine that we were probably at a strong level of support is by paying attention to where the 50 per moving average is on the monthly and where it is on the weekly, or where the 200 per moving average is on the weekly. You know, if you get to these levels, you know what I'm saying, you're going to have a huge bounce. If you get towards the 200-day moving average, we did not quite get there here. We got very close. We got very close to that 20 per moving average. I mean, to that 50 200-day moving average. That was enough for me to say, okay, probably gonna have a ricochet here soon, back towards that 50-day, because we were very close to the 200-day. Anytime you get to close to a major moving average on the weekly or the monthly, prepare for a possible major shift. And what that shift is going to do is going to push price action back up to one of your other major moving averages to develop a level of support and resistance, or a tight level, a tight window of level support and resistance is going to almost formulate some type of triangle pattern. And you're going to trade within that range for a bit. As it gets tighter, you'll see which one of the moving averages are pretty much trying to take over. You have this 50 per moving average that's getting closer and closer to this 200-day, which means price is starting to become compressed between a 50-day and a 200-day. You can either, if you were somebody like me, if I was trading, a bearish position, I got in up here, and let's say I'm thinking that price action is going to go all the way down to the 200-day moving average, or if I see this longer-term level of support that I was able to spot in the markets, even without the moving averages, you can spot those too as well. You draw a line. You draw a line in advance, give yourself a target. Let me do this. Let me get rid of this. Get rid of this. And let's do this. Let me do this. All right. So if you use a daily chart, you can also spot some longer term levels of support resistance. So if you look at this longer term chart, as price action started to trend lower, we started to bounce multiple times from this level, which tells me that this level is going to be a strong level of support. We hit it here, we hit it here, we hit it here. Once we hit it here and bounce, we went up only but so far, back to a level of resistance. And I'm going to point that out right here, because this was the level that we saw a pivot. So if you can spot pivot levels on a daily chart, you can use them as a gauge as to when to get out of position a little bit earlier than what the longer term charts are showing you. Market change directions right here. Market change directions. Let's see. Let's go. That was the biggest one. And right here. So, and you actually could have you could have spotted these on this side and right here too, right where I got a line here, market change directions right around here. That's where I got this line at, right around here, market change directions. So you can use those levels as gauges as to what you can see on the other side. Now, when price actually started to come down, you can just use those levels. Price action came down here. Where did it go? Right back to this level that you spotted over here, that you spotted in previous level, this previous history. You spotted there, you spotted there. So you know automatically that these levels are going to be strong levels of resistance, of support on the way back down. Okay, even without my movement averages. So what happens? We get up here, we get to ultimate high after we spotted this high on our SPX 200R. Price action was coming down. So you knew already that, first of all, this level was going to be a level of resistance, of support going down. If you break through that, then you know you got another level over here, which you spotted back here. So this would have gave you enough confidence to trade down to this level after we broke this level. And then at this point, you can say, okay, you know what? I made enough money on the downside. Let me get out and see how far, we're going here. Are we going to continue lower? Are we going to rally back up to a level that we've seen before in the past, which is what happened. Ricochet right back up to that level, and it stopped right there. So right there already, you already got two levels of support resistance, even without using, the moving averages that you can spot in advance. So that could be one answer to your question, is that if you can spot pivot points that you saw in the past, you can use them as gauges for support resistance in the future. All right. So spotting these pivot points that the price action reversed from or had a problem from in the past on a daily chart can give you some shorter term time frames to pay close attention to for the future. So I knew in the future, that we hit this level before and we bounce. 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 That's a strong level of support. On the way up, we came back down. We jumped above this level because we hit that level and we reversed in a big way. So I know that I got a level of support down here and I got a level of resistance up here. So what happens now? This level here becomes a strong level to pay close attention to, whether it's on the downside or upside. And this level becomes a strong level to pay close attention to. So once we broke out above this level here, you knew for a fact that your first level of support was going to be right here. And every time we hit that level, you got to pay close attention and see where price action goes. We broke through it here. So, you could have stayed in that bearish trade. And then, okay, there's another level of support that we saw in the past that was support. So more than likely it's going to be support again. And what happened? It definitely was right here. And resistance was up here and we hit that and pulled back down. Then we hit another level of resistance that was below these two, which we spotted well back here. You see how past resistance and support can show you some temporary targets? Look at that. Each time it's almost perfect. Nothing's never perfect, but each time is almost perfect. So now we knew that in the past that this level here was the level of support, was the level that we need to pay attention to. This level was the level we need to pay attention to. See how price action is traded around here quite a bit. Then we broke below it, and what happens? Back up to it. Back up to it. Could not go back up to these other levels and reverse sharply. And then what happens? We seen these levels. We seen that before too. Where look all the way over here to the left. That means that level is going to be a strong level of support. And where are we at now? So we know this whole line here because we've seen it back in, March of 2021. That level is going to be something that we got to pay close attention to because this is going to act as a magnet. And what happens? Got to bounce from it here, hit that level of resistance that we saw in the past. We're back to here. That was around December of 2022. And what's happening now? Same scenario. Back up to this level. We saw this level in the past. Well, back over here. And where are we at now? Right here in March. We came back down to this level. If you were to pay attention to what's going on to the left side of what happened in the past, you would automatically knew that there's a chance that we get a bounce right here. And we did. We did just that. always pay attention to previous levels of support and resistance, because they can give you a shorter term gauge. Even if you look at the 4-hour chart, where it shows you this, but you gotta, be able to stretch it out. And we got to bounce from here. And now we got this red candle starting to form already. So we may not make it all the way back up here to the top. We may start to reverse here. And then what happens now? This area right here is going to be an area that we got to pay close attention to see if we're going to hold it or not. And if we don't hold it, where's the next level of support? Right here, right around here. Yep. So hopefully that gave you some insight of how, how to look at look at the bigger picture, and then break it down by looking at the shorter time frames too. Look at these pivot points in the past. You can go back for years and look at pivot points, and you can spot major pivot points even on the monthly charts. You can look at major pivot points on the monthly charts in the past, and you can tell where you're going to probably have a major problem. And I think I pointed that out too at one point. Let me get rid of these charts. Let me get rid of these lines first. Get rid of some of these lines so I can show them again. Let's remove this. But I like to look at history, because even though history doesn't always repeat itself, history gives you a gauge. It gives you a gauge. Let me remove this one. So you look at some of the major problems or major levels that you got to pay attention to from the past. One of the most major levels of the past is this right here. This level right here back in 2020. That's going to be a major level that we got to pay close attention to. So that's a major level. Shorter term level, when price action started to go up, back up in 2020, where did it stop? Look at these two red candles, the monthly chart. So we had pretty much a a standstill right here, where several months in a row we traded sideways. So that was a turning point. The price action pretty much started to reverse and go back in another direction. So what happens now? You got two levels that you can pay close attention to on the shorter term time frames. Now, if I was to leave these lines here, blow it up on a daily chart, you'll see that these patterns right here are going to give you some insight on the other side. So now, as we come down, here's another red candle right here on this monthly chart. You can even draw a line here on the monthly chart. Monthly charts, anytime you see a different like a different color candle or strong wick like that, you can actually draw yourself a line if you're looking for the short-term noise. That was a reversal. That was a reversal month. That was a red month. That's the short-term noise. Now, then you got some gauges that you can pay close attention to when you start to look at your shorter-term time frames. Look at this. This is a 4-hour chart. Let me do this right here. Let's see that. Now, these are, and look at this. This is almost perfect. Look at these levels that I just drew. I just drew these levels from a monthly chart, and look how they coincide with a 4-hour chart. See how they're almost perfect? Look at right here. Had you not seen this in a monthly chart, right? Let me draw a line, because this is, I like this when you see almost perfection. Had you not drawn that in a monthly chart, you wouldn't have known that you was possibly going to get a short-term bounce there, because it was a level of level that you've seen before. Look at it right here. That was a level we've seen before, so you got a short-term pullback. Short-term pullback. This is on the 4-hour chart. So what happens? This is a level that we've seen before on the monthly chart in the past. Dip below it here, but bounce right back. You see why, if you highlight longer-term levels of support resistance on the monthly chart, if you leave them on your charts, you can almost get a sense of where price action could show some type of change, possibly. So you see how the longer-term charts and the shorter-term charts coincide. If you can actually do this on any, just look at the longer-term charts and spot out where price action changes, especially on those monthly charts. And I'm being long on this because I want you to really understand that it's not rocket science, and it's not hard to trade with a longer term mindset and be comfortable doing it. Looking for major shifts in our market. Let me get rid of this again. Oops, I didn't want to do that. I want to do this. Switch right back. So you see, this is 4-hour chart. Switch right back to that monthly chart again. Look at that. Look at that. Perfect. Look at that. See, monthly chart shows you that, and I showed you on a 4-hour chart, and everything lined right up perfectly. There was a major shift here. You got 2 red candles here. That was a turn. You got 1 red candle here. That was, a turn. And then if you wanted to, you can even put more up here. You know what I'm saying? If you was, you're looking for that particular time frame. But here on a monthly chart now, even with those lines in here, so you already know that we're in a bearish narrative. You already know that here's some short term, there's some levels of support resistance that you could pay close attention to. Now, what's the longer term picture showing me? Look at the oscillators, the full stochastics. Pretty much got a bounce from oversold levels, and it's just staying muted halfway. But look at the oscillators and wins percentage already starting to turn lower. Look at the oscillators and CCI already starting to turn lower on its monthly chart. And look at what price action is showing us on a monthly chart over the past several months. Look at that. Pretty much showed us we've been pretty much nowhere from about a year ago to now. Pretty much nowhere. There's been a lot of noise in there. Me personally, I don't like long. I don't like putting on long position when there's a lot of noise. What I like putting on when I like putting on long position, I like to see set trends like we saw over here. See that? That's what you want to see. That's a good position to be in for a longer term trader or something like that. But we haven't had that here lately. But we are definitely in a bear market. We haven't had that real lately, but we had some of it here. Had some of it here before we, got into this stagnant period. But I think we're about to get it again here. That's what I think we're about to get. So we got 2 red months in a row, right there, right here we at now. So could we continue to go down? We could, and a lot of the options market is showing us that is a huge possibility. So again, hopefully, you did this helped you a little bit by breaking this down the way I did, and for all those who's catching this on the recording. Let me erase this. All right. And before I go, let me take a look at the markets one more time, since I said this is going to be some during the market, during the while the market's running. I want to do some quick analysis. Let's see where we are now before I get out of here. And I'm gonna break this back down. Let me get rid of some of this. Because again, folks, I don't like paying attention to a lot of the news. I want to see what the charts are showing us. And right now, it's still showing a lot of bearishness. All right. Let's switch back to let's go to a 4-hour chart here. Let me get rid of this. So looking at our 4-hour chart as we before I head out of here, the bears are in control, folks, no matter what it may look like to you. The bears are in control. On a 4-hour chart, there's resistance right up here around 4,100. Don't like we're gonna get back to the level. Told folks to pay attention in the near term to this consolidation area right here. This area right here is going to act as a strong level of support resistance because we saw it act as a level over here. It acted as a level right here. Right here. And where we at now? Now we in reverse mode too. That's another thing too, which leads me to believe that this is going to just continue lower. because we were pretty much down here and then we was on uptrend. But look what's happening. So this is a strong level of support resistance. So if you're on the upside, it's going to be supportive. On the downside, coming towards, it's going to be level of resistance. And this is a 4-hour chart. So this leads me to believe that we could be running into some more pressure on the market on next week. If we don't get a strong bounce here, we're going to continue to go lower. And since we reached this level earlier in August of last year, came down to to a level of support, got a bounce here. Price action went back up, but what couldn't it do? It could not take out this previous high back in August. Only came up to right around here, which is also a level of support resistance, because we had a shift in price action back here in August. So if I was to draw a trend line from there, you would see that that was another level that we could have paid attention to in the short version. Could not make it back up there. We continue to break down. So this now, to me, is no longer relevant. So I can get rid of that. What's relevant is this area that we're at now. All right, and now look at the oscillators in the 4-hour chart. It's now 226. This is the 4-hour chart. It's 226. Price action is in a struggle mode. Now, look at even a near-term picture. Price action is in struggle mode. We already know what the longer-term charts is showing us. Price action is in struggle mode. We made it back up to this level. There's a lot of choppiness here, so that was a good place you can pretty much draw. And this long wick right here, you could draw a line here. Let's put one here. That's a lot of noise in between, because you saw a pivot point here, you saw a pivot point here. Price action went up, a pivot point here, price action went up. Then what happens? We go back up to this level and look what's happening. We're stalling out, folks, already. Not only is that showing us a stall right before we even get, try to put on a fierce bull run, and looking at the short-term chart, look what the oscillators are showing us. In the stochastics, it's already ready to start to turn lower. This percentage is heading lower. CCI already want to head lower. Now, okay, you say, okay, that's still hard to read. Throw some moving averages on here. So let's switch over to one of my other charts. Pull up a 4-hour chart here. Expand this out. And you'll see the same type of trouble. You can look at it in different ways. You can look at it without the moving average. You look at it with the moving average and spot longer term support resistance, like I just showed you. Or you can say, okay, it's a 4-hour chart. What are the moving averages showing me? Moving average is showing you that it's still negative, even on a 4-hour chart. Even if I was to break this down to an hour chart, I can show you negativity. Okay, we got a bearish crossover here, which was about a week ago. Price action made it back above its 20-per moving average right here, but look what it did. It did not turn the 20-per moving average up. It continued to go lower. So that means look for the next level of resistance. The 50-day, it got rejected there, came right back down, pushed price action all the way back below the 20-per moving average and the 200-day moving average, right around this level of support that I highlighted that we saw on another screen without moving averages. And what's happening now? And I'm even going to show you something that's even more dire. Let me get rid of this shaded area so you can see what's happening. More dire. Now, not only is price action bumping its head up into this on this 4-hour chart, up into this 200-day moving average, it's getting rejected. It's getting rejected right there. And we also got our first crossover of the 20-day crossing below the 50-day on this 4-hour chart. Strictly bearish. Unless we see this yellow line turn upward, it is a bearish narrative, and it's like it's just continuing to trend lower. Price action is staying muted below the major moving averages. So unless price action breaks above all major moving averages, if it gets past this 20-per like it did here, we need to see the 20-per move up. If we don't see the 20-per move turn upward, and price action jumps above it like it did here, then that means it's going to run into the next moving average, which was the 50 per, and come right back down. So that's how you got to look at this from this point on, is look at these moving averages. We are definitely in a trending channel lower. So as long as we're in a trending channel lower, all the major time frames, I'm going to trade this market bearish. Okay, unless we get a shift. And right now, this is not showing me a shift. Even on a 4-hour chart, it's not showing a shift in sight. So any rally, it's going to probably be muted, which is what's happening. You see a little rally on this week, what happened? It got muted. It got muted. We're back up to a moving average. And if you was paying attention to the crossover and the moving average, knowing that the moving averages were not budging, they were still heading lower, even as price action was rising. Price action is not going to go against the grain. Okay, even if we would have broke well above this 20 period, it would have had to deal, it would have to contend with this 50-day moving average. And unless the 20 period was starting to turn up like so, as price action started to go towards this 50-day, then this rally was just a rally that was going to be muted, which is what we saw. We didn't even make it back up to the 50-day. We made it right here to the 200-day and the 20-day, and then we start to head lower. And not only did the price action start to head lower, 20 period moving average crossed below the 200-day, and it is just going lower. Now, price action is right above that 20 period moving average, and it's struggling to get above that. So if it doesn't get above that, it's going to just 20 period moving average is going to start to curl lower, and price action is going to hit it and come back down. Ultimately, 20 period moving average forcing price action below all of this, which is where we're going to see the next big leg down. It's a possibility. 4-hour chart, look at the oscillators and the full stochastics, it's going to turn negative. So paying attention to the long-term charts will give you a general idea where we can see a major reversal. And then looking at the shorter term charts, it just gives you confirmation that the trend is still trending in your favor. And that'll give you more confidence to stay into that trade. You can use this type of trading even on your on your indexes. I mean on your regular stocks. But using on regular stocks can be not as concrete, because anything can happen to a stock. You can have some major some major shift, the company bought out a company, something like that, and then you can have a major turn in the other direction. So, but I like to pay attention to the major indexes, because the major index is going to show you what the overall market is looking like. And looking at the sentiment tool that we use. All right. Now, with that said, price action right now, folks, on the S&P is almost back at 3,900. A level that I told folks to really pay attention to is that 3,800 level, because that 3,800 level in the S&P is going to be detrimental. It's going to be detrimental. That 3,800 is right around all this noise. All this noise is about the bottom of all this noise. What I mean by that noise. So around the bottom of all this noise, that's where this 3,800 lies. So there is that 3,800, which is what I'm saying you got to really pay close attention to over the next week or so, because, and as you can see, look at that 20 period moving average, folks. It is not curling up going higher. It's going lower, and it's going lower. So price action is being compressed by that 20 period moving average, and that 20 period moving average continues to drop below all these levels of support. Price is going to follow, and it should be no time for us to be back below 3,800 in a meaningful way. And again, for the last time, if we drop below 3,800, folks, look at a monthly chart. It is going to be really detrimental for the bulls, because 3,800 right here becomes 3,500, 3,500 becomes 3,400, and then anything below 3,400 is going to put us in that fatal funnel that we've seen in 2020. All right. All right, folks. Man, this is some good stuff. Any other questions before we jet out? Anybody want to look at a specific stock? I can, analyze a specific stock for you before we roll out, or a specific sector. Again, for those who came late, don't sleep on the gold sector, folks, because the gold sector is in a new bull market. That's my story, and I'm sticking to it. That gold chart is like it looks like definitely a price magnet right now, like a gold mine, like it's ready to really kick off in a major way. So, and a lot of times when you see gold start to really perk up like that, then something's definitely happening in our market. That folks don't feel comfortable, don't feel safe. You know what I'm saying? And they flock to safety. And right now, it's like safety is gold is becoming that safe haven again. Sometimes it doesn't act as a safe haven, but gold, folks, has been acting as a safe haven, and it's approaching some major levels. Here is this look at this strong. Let me switch to look at that strong move on gold this week, folks. Look at that big cold. It's almost it's the most bullish candle. There's no wick on the top or the bottom as of right now. We at 1982. Back in October, gold was around 17,000 or 16,000. Here we are now in March of this year, trading at 1982. Gold is on the way up, folks. Don't sleep on it. If you want something in your portfolio that can be good for the duration of this year, probably gold may be the answer for a bullish narrative. Gold may be the answer. Here's a monthly chart of gold. Look at where it's resting at. Monthly chart resting right on that 20-period moving average. And look at what's happening in the month of March that we're in. Look what happened the previous 2 months. This green body is already above both of these past 2 months. That is a strictly bullish narrative for gold. All right, folks, I am heading out of here. I think I went overtime, but I like this. So this is enjoyable for me. Hopefully it was something that was great for you guys. Again, the time is now 2:38 p.m. on Friday. All you bulls, be careful out there. Here is a current look at our Dow Jones as we in this session, as we race towards the closing of business on Friday. We're still down about 482 points on the Dow. The bears got full control of this market right now, folks. Down 482 points on the Dow. On the S&P, we're currently down about 53 to 54 points. On the S&P, as we head into the end of a trading week, a lot of negativity still circulating around the issues with the banks. Friday is turning into a real negative day with the oscillators, with the moving averages starting to compress price action lower. 20-period moving average is hovering right above price, and it's about to curl down and go down, which means price is probably going to follow the moving averages down. If you look at our NASDAQ, which is the stronger of the two, according to the daily chart, but it too is about to possibly run into some problem. Look at the Williams percentage on the NASDAQ. Was in overbought territory, and it's starting to turn lower. The oscillators, the Williams percentage, starting to turn lower. Price action is currently above the major moving averages on the NASDAQ. But what I will point your attention to, look at the convergence. The 20-period moving average is what I really want to focus on. It is trending downward, as the 50-period moving average is still trending upward on the NASDAQ. The 20-period moving average is not following the narrative. It's trending downward. So it looks like it's about to happen. So by next week, we can see the 20-period moving average below the 50-day and the 200-day on the NASDAQ, which is going to turn the whole narrative bearish for the NASDAQ as well. So, and the NASDAQ right now is down about 117 points. Look at the Russell. Russell already have the 20 period that's crossed below the 50 period moving average. And it's down right now about 47 points. Folks, the market is getting beat up. And now let's take a look at the VIX for one last time. VIX still looks positive on its daily chart. And not only does it look positive, folks, let me point this out real quick. Not only does it look positive, you look very, very closely at the full stochastics. Looks like the green line is starting to cross back above the red line in the oscillators within the full stochastics, which means that the VIX is almost like it's ready for a next move up. We're starting to approach the end of the day. If that stays that way, then that means we can possibly see a big move in the VIX, excuse me, next week. And what's happening next week, folks? We got the Fed speak on Tuesday. So the Fed's going to do, it's probably going to do one or two things. It's either going to cause this VIX to continue its next leg higher, or it will sink the VIX and cause it to drop below major moving averages. But if I was a bet man, I think those things are over. I think it's not too much the Fed's going to be able to do in order to compress this VIX again back below 20. All right. Okay, folks, so there you have it. That is my analysis of the market this week. Hope you guys enjoyed this live analysis of the market. And if so, what I'm gonna try to do is I'll try to do another one here. You know, within the next 2 weeks. I want to give a lot of this data time to sift into our markets, and then we'll take another look and have another live assessment of the market. All right. Enjoy the rest of your trading day, folks. Enjoy the rest of the week. If anybody needs to reach out to me, very welcome. If you need to reach out to me or like to reach out to me, feel free to reach out to me on Rose's Discord and my channel. Really want to thank Rose for allowing me a place to come back and share, because this is what I've always liked to do. So really a big shout out to Rose. Guys, she is excellent in what she does. So continue to follow Rose. All right. All right, folks, catch you guys next time. Enjoy the rest of your day.